An ugly 3-year Treasury auction, and copper hits a record high. So today we had a $58 billion 3-year Treasury auction, and here are the results. If you want a more in-depth explainer on how to interpret these particular terms and how Treasury auctions work, I have a video that I'll put at the end here. But very briefly, high yield versus when issued and the resulting tail or stop through. This is the difference. Remember, Treasury auctions are Dutch auctions, so everyone gets the same price or the same yield, and you go up in price or down in price until the entire 58 billion is absorbed. If the bonds are trading, if there's a huge amount of demand and the price that is needed to clear 58 billion is higher than the when issued, then that's called a stop through, and that a stop through indicates very strong demand. On the other side, a tail indicates that they had to go down in price or up in yield in order to absorb the entire in order to offload the entire 58 billion. A tail is a sign of weak demand. Also worth noting, you cannot take these metrics and just compare them to the video we did on the 10 or the 30-year auctions. Shorter maturities have higher liquidity. As we can see, $58 billion was issued in 3-year. You look at those longer maturities like the 10, 20, or 30 years, and we're only issuing 20 to 30 billion. So there's higher liquidity at the short end, higher demand, less volatility because there's less duration risk, less convexity. So it's not a one-to-one comparison where, a 1 basis point tail on a 3-year auction is a lot different than a 1 basis point tail on a 30-year auction. It is more meaningful to see on a short maturity like this, or shorter maturity like this, is much more meaningful to see a half a basis point in a tail. Bid to cover, again, is also stronger. This indicates what I was just referring to. Bid to cover, this is higher than what you'll see at the long end auctions, where the bid to cover is much lower in terms of the bid to cover ratio. This is the amount of bids relative to the size of the auction. You just divide the two, you get a ratio there. 58 billion in supply awarded at high is exactly what it sounds like. This is the share of that 58 billion, the percentage that is awarded at the high yield, or put another way, at the low price. This is the composition. This is where you can see exactly who is buying the bonds. Primary dealers, these are the buyer of last resort. They took down 16.5%. Direct took down a record 29%, as we'll see in a second. Indirect, this is foreign demand, took down 54%. Now, I want to point out the 30-year, we did a video earlier this morning on the Japanese bond market, but look at, even here in America, even here in the US, I will go to the daily chart now. We were approaching 5% on the 30-year. Remember, this is where things like mortgages are priced, and we hit 497 on the 30-year bond yield today. And I will zoom out now to show how close we are to, decade highs basically on the 30-year. I will zoom way out. The last time we were in these levels was going all the way back into 2007, leading into the GFC. That was really the last time that we were up near 5% like this. Also important to note, the last couple times that we were up here at 5% on the 30-year, we had higher growth and higher inflation. For example, here in the end of 2023, we had much higher nominal growth. And we also had higher nominal growth here in the beginning of the year, in January of this year. So the fact that we are back to 5% with lower nominal growth is a big story. You have to look at it in context. You cannot just look at a simple chart of the yield and get a ton of information from that. The context really, really matters. So here's the yield curve in its entirety, or the way that I visualize it. The shortest maturities are the lightest color, going out the rainbow. Here we can see since the Fed started to cut rates right before the last election in September, a 50 basis point cut, but since that rate cutting cycle began, the curve has steepened. What this means is the difference between the short maturities, like say the 3-month or the 1 year, and the long maturities, say the 30-year, that gap is widening. That's called a bear steepener. The reason it's a bear steepener is because rates are going up. In general, rates are going up across the curve. What that means, again, yields are inverse to the value of the bond. So the value of the bond is going down, the yield is going up. That is called a bear steepener because it's bearish for bonds. This is in contrast to, say, a bull steepener, which I will illustrate very quickly here. Going back to 2008 and the GFC, we can see the difference between the long and the short maturities widened as the Fed was cutting rates, as the GFC was taking hold. We can see that the shorter maturity, the yields dropped way more quickly than the longer maturity. So, longer maturity, like the 30-year, the yield did come down, but it came down less quickly than the short maturities were. This is called a bull steepener. And the reason for this is, again, it's bullish for bonds. As we can see here, remember, they are inverse to each other. Yield is inverse to the value of the bond. Trump made more comments today that I think are worth mentioning. He called on Powell to cut rates yet again and said he's too late and he needs to cut rates. The more time that goes by, the more convinced I am that if Powell does not cut at this July meeting, that'll be Trump's line in the sand. I also think it's increasingly likely that we are going the route of the kind of run it hot, run the economy really hot, inflate our way out of the debt, sort of fiscal dominance approach. Trump is talking about cutting the overnight federal funds rate, the white line, by 300 basis points down here. And we have unemployment at 4.1, which is near historical lows. The economy in aggregate is fine. For many people, the economy is not doing too well, but in aggregate, the data is relatively strong. To cut 300 basis points, given a historically low unemployment rate, I think this just indicates that Trump not only wants to cut the overnight rate, but also then issue all of the debt at the short end. This is what emerging markets do. It's very stimulatory. It's very inflationary. I expect the curve to steepen more. This is one way to visualize that. This is the 30-year minus the 3-year yield. And we can see that the curve has been steepening since I called for it, I think in September of last year was when I became convinced the curve would steepen. The curve has steepened, but look at like relative to historical period in time. We are only at 100 basis point spread between the 30-year and the 3-year. If you go back to kind of a high back here, that's a 300 basis point spread between the 30-year and the 3-year. So, I think that this cannot tell you whether it's a bull steepener or a bear steepener. As we established, we are in a bear steepener. That is bearish for bonds. But this can show you the relative spread between shorter maturity and longer maturity. I expect that this does continue to steepen. Remember, the 30-year, the longer maturities, that's where mortgages are priced off of. That's where credit card interest rates are priced off of. That's where auto loans are priced off of, right? The overnight federal funds rate is only really important to the financial institutions and for in this case the U.S. government in terms of financing all of their debt on payday financing, very very short term basis with very low duration risk. That cutting the federal funds rate, cutting the short rate, in terms of for the average person, you're not going to really feel much other than probably see asset prices boom. But eventually, as long-term rates, as the curve continues to steepen, I think eventually long-term rates go up, especially if Trump appoints a shadow Fed chair. They are mega dovish, talk about cutting to a ridiculous degree. I think long-term rates might even go up, even if they just go sideways in the face of 300 basis points being signaled in Fed cuts. Even just sideways alone would be very bearish to me in my estimation. So here's copper hit a record high of 5.50 per pound, US dollars per pound. This is the COMEX copper futures. This chart goes all the way back to 2000, and we can see it's at a record. This is on news of a 50% tariff on copper. We can see that copper rallied quite significantly. I will measure this out here. From the tariff announcement to the peak, copper ripped up 13% higher. It's a massive move. So looking at the auction, this is again from Zero Hedge. I really appreciate his sharing his Bloomberg terminal because I don't have access to some of these charts. other than through zero hedge. Here is the tail relative to the stop through. Again, a stop through indicates strong demand, a tail indicates weak demand. And we can see that starting when the Fed started to cut rates, looking at this as a cutting cycle, since that cutting cycle began, we've only had two stop throughs. All of the other auctions have tailed. And while this particular tail is not nearly as bad as the 2.5 basis point tail a couple months ago, the fact that since the cutting cycle began, remember, there should be more liquidity at the shorter maturities. The Bloomberg asset managers, right, that go on Bloomberg TV, they like the belly of the curve. They've been saying it for over a year and a half. We like the belly of the curve. We don't like the long maturities. We like the belly of the curve and kind of the shorter end. So again, dynamics are different. If you see a 1 basis point tail on a 3 year, that's more meaningful than a 1 basis point tail on a 30 year. And the fact that this has been tailing, to a significant degree since the start of the cutting cycle, I think is significant. Here is the percentage of that 58 billion that was awarded at the high yield, or put another way, at the low price. We can see this at a record 29.4%. This chart goes all the way back to the early 2000s. Remember, direct. This is institutions bidding directly for their own portfolio. Here is historical composition of the bidders. And again, we can see the high yield. This is basically the yield chart that you would see if you looked up the yield on the 3 year. Bid to cover, this is the size of all the bids relative to the supply, which in this case is 58 billion. You divide those two numbers, you get a bid to cover. And it's down significantly going back to 2012, 2013, which just so happened to coincide with the peak in the net share that foreigners held of U.S. Treasury debt was 2013. And ever since then, the bid to cover on the 3 year has been declining, indicate somewhat waning demand. Here is direct composition. The composition of the 58 billion. Red indicates direct bidders. Remember, we established that hit a high of 29.7%. We can see that going back all the way to the start of this chart in early 2000s, that is a record. Indirects, which is again foreign demand, had relatively low percentage of the composition, and primary dealers. If you're looking for good news or bullish indicator, primary dealers, the amount of primary dealer take up. Remember, primary dealers are the buyer of last resort. That primary dealer take up has been takedown has been going down, and so that could be seen as a bullish indicator. But again, the fact that the bid to cover is down since the start of the cutting cycle here in September, of 2024, excuse me. Bid to cover is down, and indirect bidding is down. It's tailing. It's not the most ugly auction, but it is indicating some issues. Now, this is not limited to just the U.S. Here are yields. I picked a bunch of random countries, developed market countries, and we can see that again. We did a video on Japan where long-term rates are ripping higher. This is true for most developed economies. We can see that starting on July 3rd, that appears to be when rates really started moving sharply higher. These are all 10-year maturities: Canada, France, Great Britain, Italy, Korea, Spain, and Germany. Long-term rates have been moving higher over the past week. This is not limited to Japan. It's not limited to the U.S. And again, just look at the shape of the 30-year yield versus, say, a shorter maturity like the 3 year. Going back, the 3 year, again, remember, this is inverse to the value of the bond. It appears, if you're a trader, this would look like an inverse head and shoulders, like a bottom, like it's headed higher, which I believe it is. I still think we get 50 basis points of cuts. But the 30-year, the longer maturities, look much weaker. Again, remember, this is what, if you're in TLT, you're probably familiar with this sort of chart. TLT is pretty ugly, and I think it's only a matter of time before it sets a new low. It's not guaranteed. You can say that it's going to hang on to this 83.50-ish level, but I don't know. With all the shadow Fed talk, fiscal dominance, and all those concerns, all the various things we've been talking about on this channel, I think that the TLT is going to set a new low, and the 30-year yield will move even higher. Again, we approached 5% with nominal growth much lower than it was back here in late 2023, or even here in late 2024, early 2025. Nominal growth is lower. So you can't just look at this in isolation. I think mix it in with Trump's comments, mix it in with the fiscal concerns and the debt and deficits, the fiscal side and the one big beautiful bill. All of these different, the shadow Fed, fiscal dominance, all these contributing factors, I think the curve will continue to steepen until eventually long term rates are so restrictive on the real economy that they have to do an operation twist where they issue debt at the short end to raise cash to buy the long end, bringing long term rates down. I think that's kind of the what seems to be much more likely as time goes on. Seems that's the direction that we're headed in. So there's another 10-year auction tomorrow, which we'll do a video on as soon as the results are out. So stay tuned for that. And yeah, I will catch you tomorrow.